Hey everybody, Economic Ninja here. I hope you're doing great. I have got a ton of amazing questions from you, my subscribers, about real estate. And I want to knock out one of those questions right now. And that is, can you list the pros and cons of deciding to purchase single family homes between cash, using cash, or financing it with insurance rates being excessive? Now, this is a great question, and it's actually one that's on a lot of people's minds right now. Regardless if you could pay cash or not for a home, it's the insurance crisis, right? But there's a little bit of a problem with the question. You see, a good solid investor doesn't look, they say the devil's in the details, right? But the problem is you can't get down to the details to make a lot of money or save a lot of money until you actually deal with and jump into the broad actual spectrum. And to me, in real estate, that is first deciding if you're gonna buy a home and where we are in the real estate cycle, right? So once you do that, then you start thinking about the small stuff. And looking at the whole insurance crisis, I get it that insurance costs are super outrageous. The problem is people are actually paying off their homes right now with the specific intention of canceling their insurance. And I honestly believe that is a very, very bad idea. Why? Well, if something happens to your home, and I get it, nobody thinks it's gonna happen to them. I was a professional firefighter, a career firefighter for 23 years, had served 26 years in the fire service total. And I can guarantee you this, every single home that burnt down that I went to, I heard the same thing. I cannot believe this has happened to me. It absolutely blows my mind. Although it's the same thing in very serious vehicle accidents. I never thought this would happen. That's the problem. And you're looking at how much are you gonna gain by saving insurance, by self-insuring, and do you actually have the money to self-insure? Most people actually don't have the money for that. Well, let's talk about rentals. This question is specifically about buying rental property. Well, think about it. It's one thing if you live in your house and you're very safe and an accident happens. But how accident prone can one of your tenants be? Another question I need to bring up is when we're talking about the difference between paying cash for a property to save money on insurance or using a bank's money to buy a home, it is night and day difference. And I'll give you an example. But actually, real quick, I have to say, if you want to be a part of this upcoming live training that I'm doing, where I'm gonna be talking about exactly where we are in the real estate cycle and then answering your questions live in a private forum, then go ahead and take a look at the link down below, sign up for the newsletter, and you'll be sent an invitation within 2 weeks for a live event where I'm answering your questions live. We're talking about real estate and how to make money in real estate. So go ahead and check that out. Now, as far as leverage, think about this. Let's use round numbers. You had found a home for $250,000. I know that sounds crazy all over the country, homes are pricier, but just stick with me as far as the round numbers. And you had the $250,000 down to just buy the house outright. And let's say it rented for $2,500 a month, just keeping it easy, right? So now you're making $2,500 a month on your investment of $250,000. You have to ask yourself, put it down in the comment section below. What rate of return is that per year? If you multiply $2,500 times 12, that's pretty easy math. We're looking at what? $30,000? What's $30,000 divided into 250,000? What kind of rate of return is that? Now, what if you would have used a bank's money? And think about it this way. Even with interest rates at 6%, 6.5%, 7%, but you only put down the bare minimum to buy that house. Sure, you're gonna be making a lot less than $2,500, right? Because you're gonna have all kinds of different expenses. But you have to also remember, you've got a lot of money left over. And you're gonna go and do that again and again and again. And if you purchase the property during the right time of the real estate cycle, when appreciation should be looking up, I know it sounds crazy, but there is a time to know exactly when that is based on interest rates and mortgage rates. They're two totally different things. The federal funds rate and mortgage rates, two totally different things affected by different influences. However, most people think they're synonymous with each other, but they're not. There are these really small differences that actually can add up to a ton of savings, depending on the time in which you buy or sell real estate. So the question is a broad question. And what I would suggest is never drop your insurance on your property. If you can't pay the insurance on your property, perhaps you may not want to own real estate. But if you plan properly and you buy the property right, the rent on the property will cover all of your expenses, including insurance. The question is, what are you willing to take on as risk? I like risk avoidance. I like having a low risk tolerance because that frees me up. Instead of focusing on one property, I can now focus on the next 10, the next 20, the next 50. That's how I do it. Hope you got something out of this. If you want to be part of the live training, click it down below. It's going to be completely free, but we bring people onto a Zoom style video because it's just so much easier to spend more time with you. It's probably going to be around an hour long, and I hope you get a lot out of that too. It's totally free, and I hope you get something out of this video. The Economic Ninja is out.